Let's start then with TeamLease Services, which came out with the Q4 earnings yesterday. Revenue growth has slowed down a bit on a year-on-year basis. The company has clocked in a revenue growth of about 11.5%, which is lower than the recent growth rates for the company. For the full year, they have ended with a 21.5% top-line growth. Margins, too, have come in under pressure. Ramani Dathi, the CFO of TeamLease Services, is now with us on the show. Ms. Dathi, morning, and thank you very much for joining in. And I understand you are taking a bit of a non-executive role now at the company.
Yeah, right now I'm in a maternity leave, but I'm working on-off.
Oh, congratulations then. Busy times for you. You've got your hands full personally and professionally, but it's a wonderful news. I just wanted to talk a bit about the margins then. Your margins have been coming under pressure. FY23 margins were 1.6%, which compares with FY22 margins of 2.2%. What is the guidance on margins for FY24 and the drivers?
Rima, this year has been a mixed bag for us because we have phenomenal growth in our general staffing business. We added 29,000 net headcount, which is our second highest in whole of last decade. But that has been completely taken over by the headcount loss in our degree apprenticeship business because of the withdrawal of NEEM scheme. So we lost 30,000 headcount there. That has straight away wiped out the entire net addition that we did in general staffing this year. And in terms of margin, our highest margin business is specialized staffing, which is mainly the IT staffing business. And with the macro environment over there, so that there we lost headcount as well as margins. So that has taken a toll on our overall margins for this year.
Any guidance for FY24 on margins and top line?
Yeah. So even for FY24, Q1 and Q2, we believe the slowness in IT will continue, even the degree apprenticeship program, given the uncertainty around the scheme. So we may continue to lose some headcount during Q1 and Q2, but Q3 onwards, we are hoping that both IT as well as the apprenticeship headcounts will start picking up. As far as general staffing is concerned, we are seeing very good consistent growth, uniform growth across segments, while BFSI has been the largest contributor for us. So we are seeing good headcount addition from all of our large customers across all industry verticals. And we have added about 8,000 net headcount in Q4 in general staffing, and a similar trend or slightly higher trend can be continued quarter on quarter for coming year as well.
Okay, got that. Ramani, hi, and good to have you on our shows. Since you mentioned the slightly sluggish outlook on the specialized staffing side, also give us an idea about realizations. I mean, how did that piece move in the fourth quarter, and will realizations remain under pressure, maybe in the first half of this year?
So specific to IT staffing, at this point in time, yes, there is pressure in realizations because what happened is during COVID times, there has been a very high increase in the salary levels of IT professionals. And to some extent, we have managed to increase the rate cards with the customers, but there has been a margin pressure. And now with the current macro environment, that pressure is continuing. So this year, we have seen a margin drop in our specialized staffing business. In coming years, especially Q1 and Q2, we are doing massive cost corrections. We have already reduced our core employee headcount by 8%. And we are also doing a lot of cost optimization measures, which will ensure that our specialized staffing business is back to 8% EBITDA margin by Q2, because Q1, again, we have employee appraisal impact, annual employee appraisal impact. Q2 onwards, we should get back to 8% margins.
Okay, that should happen Q2 onwards. You mentioned specialized staffing, which has seen a slowdown. Are there any other segments where you're seeing this kind of slowdown play through? And also, do you have any startup exposure?
We have very small startup exposure, like about some 2% of our general staffing headcount is to startups. And that's where we have seen slowness, and we already lost the headcount. So right now, that 2% has even come down to maybe 0.5% or less than 1%. So we are not expecting any further headcount loss as far as startups are concerned. But IT, we may continue to lose some more headcounts as well. But in general staffing, other than startups, at this point in time, we are not seeing any headcount losses or any headcount hiring freeze in any other verticals.
Okay. You've guided for specialized staffing services margins to get back to 8% by Q2 of FY24. Any other guidance that you could share on the overall margins then?
On the overall margins, it's very difficult because our top line, which is the associate salary, we don't have any control on that. While we are trying to improve the margins sequentially quarter on quarter, giving a specific number is very difficult given the nature of our business.
Okay. And what's the extent of cost optimization? How much do you think you will be able to extract via cost optimization measures?
Yeah. So as I mentioned, between September 2022 to March 2023, in the last 6 months, we have reduced our core headcount by about 8%, almost 200 kind of headcount we have optimized. Again, this is largely in the businesses of degree apprenticeship and specialized staffing. So that ideally should give us an upside on the margins, but given the loss of headcounts and margins in these businesses, that has been fully absorbed and we have seen a slight dip in margins. And going forward, we are targeting at least a 20 basis point improvements quarter on quarter, starting Q2, again, on back of both the cost optimization as well as headcount growth across the businesses.
20 basis points margin improvement in Q1 and Q2, right? Sequentially.
Q2 onwards.
Okay,
yes.
Q2 onwards. And you also guided for general staffing headcount addition to continue at that 8,500 run rate.
Yes, that's right.
Okay, got that. Thank you very much, Ramani, for joining in. That's TeamLease for you. The next quarter could be a bit subdued. After that, things will pick up on the margin front, and the second half of the year will be better in terms of the headcount addition. Get into